A recession is a significant decline in economic activity that affects various sectors, including employment, production, and consumption. While predicting a recession with absolute certainty is difficult, economists and financial analysts closely monitor key financial indicators that often signal an economic downturn. By understanding these indicators, businesses, investors, and individuals can prepare for potential economic challenges. In this video, we will explore the top 10 financial indicators that can predict a recession. 1. Inverted yield curve. The yield curve is a graph that plots the interest rates of government bonds with varying maturities. Under normal conditions, long-term bonds have higher interest rates than short-term bonds. However, when the yield curve inverts, short-term interest rates surpass long-term rates, which is often seen as a warning sign of a recession. An inverted yield curve indicates that investors expect economic growth to slow down, prompting them to seek long-term bonds for safety. 2. Rising unemployment rate. One of the most noticeable signs of an economic downturn is a rising unemployment rate. During a recession, companies may reduce their workforce to cut costs as demand for goods and services decreases. A steady increase in unemployment, particularly if it continues for several months, can indicate that a recession is approaching. The unemployment rate is a lagging indicator, meaning it typically rises after other economic indicators have already begun to show signs of a downturn. 3. Declining consumer confidence. Consumer confidence measures how optimistic or pessimistic consumers feel about the state of the economy. A significant decline in consumer confidence is often a precursor to a recession. When people are uncertain about their financial future, they tend to reduce spending, which can lead to decreased demand for goods and services. A drop in consumer confidence can signal that consumers are bracing for an economic slowdown and tightening their spending habits. 4. Decreased consumer spending. Consumer spending accounts for a large portion of economic activity, particularly in consumer-driven economies like the United States. A decline in consumer spending can be a strong indicator of a recession. If consumers are spending less on goods, services, and big-ticket items like cars and homes, it can signal that households are facing financial difficulties or are becoming more cautious about the future. This reduction in spending can lead to a slowdown in economic growth. 5. Falling stock market. Stock markets often reflect the health of the economy. A significant and sustained drop in stock prices, particularly in major indices like the S&P 500 or Dow Jones, can signal investor pessimism about future economic prospects. A bear market, a drop of 20% or more in stock prices, is often associated with an impending recession. If investors believe that corporate profits will decline due to a slowing economy, they may sell stocks, causing a sharp market downturn. 6. Slowing GDP growth. Gross domestic product, GDP, measures the total economic output of a country. A slowdown in GDP growth, or a contraction in GDP for 2 consecutive quarters, is a traditional indicator of a recession. When GDP growth slows or becomes negative, it suggests that economic activity is declining, and businesses may scale back on production and investment. A shrinking economy can lead to lower income levels and higher unemployment. 7. Rising inflation. Inflation refers to the rate at which the prices of goods and services rise over time. While moderate inflation is a normal part of a growing economy, rapidly increasing inflation can be a warning sign of a potential recession. High inflation can erode purchasing power, reduce consumer spending, and lead to tighter monetary policy from central banks. If inflation remains high for an extended period, it may signal that the economy is overheating and could be headed toward a slowdown. 8. Declining business investment. Businesses typically invest in capital projects, technology, and expansion when they expect future growth. A decline in business investment can signal that companies are anticipating weaker demand and are hesitant to commit to large expenditures. Lower business investment can result in reduced productivity, fewer job opportunities, and slower economic growth. If companies pull back on their investments, it can be a clear signal that a recession is on the horizon. 9. Rising interest rates. Interest rates play a crucial role in the economy by influencing borrowing costs for individuals and businesses. When central banks, such as the Federal Reserve, raise interest rates, borrowing becomes more expensive. This can slow down consumer spending and business investment, both of which are key drivers of economic growth. Rising interest rates, especially when accompanied by a slowdown in economic activity, can signal that a recession may be approaching as central banks attempt to combat inflation. 10. Widening trade deficit. A trade deficit occurs when a country imports more goods and services than it exports. While a trade deficit is not inherently negative, a widening trade deficit over time can signal economic instability. A larger trade deficit may indicate that the country is consuming more than it produces, which can lead to higher levels of debt and economic imbalances. If the trade deficit continues to widen, it may signal that the economy is relying too heavily on foreign goods and services, potentially leading to economic challenges. While no single financial indicator can predict a recession with absolute certainty, the combination of these 10 signs can provide valuable insights into the health of the economy. Monitoring factors such as an inverted yield curve, rising unemployment, declining consumer confidence, and falling GDP growth can help businesses, investors, and individuals make informed decisions about their finances and prepare for potential economic downturns. By staying alert to these warning signs, it's possible to take proactive measures to mitigate the impact of a recession and safeguard financial stability.